And just quickly, do you think that banks have done enough to pass on rate cuts, not just in terms of mortgages, but in terms of credit card interest and business loans?
Well, we'll wait and see where they go with this cut. We don't think the cuts are finished yet by any means. We do note there's quite a bit in the pipeline. We have, until today, we had seen the official cash rate drop by just under 5%. We'd seen floating rates drop by just under 4%, and I think we'd seen two-year rates drop by just under 3%. The longer-term lending rates haven't dropped by as much, and that's basically because longer-term funding has been much more expensive and hard to get. So it becomes quite a tricky question depending on a bank's balance sheet. But, yeah, they're very aware of that, and we have seen some reasonable cuts coming through. Of course, it takes a while for them to come right through into the New Zealand economy because in the case of mortgages, there's probably, on average now, about a year that you have to wait to see the actual rate being reflected through in new mortgages.
Dr. Bollard, there was an unusually large range of expectations of what you would do today, possibly reflecting the uncertain times and so on. I think it ranged from some people thinking you might do nothing and others saying 100 basis points. Can you just talk us through why you opted for 50 basis points?
We opted for 50 basis points because we clearly thought we've still got a very weak situation and we still have time to put in place monetary policy changes which will be helpful in this cycle. We've been helped in all of this because we've been onto it reasonably early and got a lot of stimulus in place. We were more thinking about how do we manage the move towards the trough in interest rates or the trough in the OCR. Because as we're clearly signalling, we're not going to keep cutting forever, and actually we don't want to be in a position like the Federal Reserve or the Bank of England cutting to very, very low rates. So we're, if you like, cutting into a bit of a glide path on our OCR profile, and we're signalling that future rate cuts will be much less than this.
Just on another issue, Standard & Poor's has issued a warning saying they might downgrade New Zealand's credit rating, sovereign credit rating. Have you factored in a downgrade, and what do you assess as the chances that they will downgrade?
No, we haven't factored in a downgrade, but we've basically got a story which is reasonable recovery in relative terms, not bad compared to our trading partners and to other parts of the world. Of course, the uncertainty in our forecast is very much derivative of our uncertainty about whether the world economy troughs this year, which is the broad consensus view, or whether or not the more pessimistic view holds, which is the world economy continues to contract into next year and only then picks up. Were the latter to take place, then we'd have a difficult year ahead, showing through in things like operating balance and current account deficit, the sort of signals that rating agencies would look at. However, on our forecasts, we think they don't look benign, but they look controlled and they're heading towards improvement, and the rating agencies understand that.
Dr. Bollard, what impact did the Australian decision to hold their rates have on you, and if any, was it because of the impact on the currency of a differential?
Well, it's good to have gutsy central banks around the region, but beyond that, no particular impact. We keep in touch with them to understand what's driving their forecast, particularly where there's common features. But we've made our own decision on this.
Dr. Bollard, you talk in the statement about a higher risk aversion around the currency. What's driving that?
I'm not sure if I did talk about higher risk aversion around the New Zealand currency. Oh, you mean in the statement, somewhere in the statement more broadly?
Yes.
Well, I mean, we're in a environment with a lot of volatility, a lot of vulnerability, and a lot of uncertainty around the real aggregates and the financial aggregates, and that's showing through on exchange rates around the world. And you'll have observed a period when overnight we've been seeing bad news in the US and US stock markets, it's almost become mechanical that the consequence of that is that the US dollar rises and the New Zealand, the Aussie and many other traded dollars go down. That's simply been a move towards world reserve currency under a stress situation. New Zealand is a small currency, small trading, and we'll always be awake to that. We don't forecast the exchange rate, but we do try and work out a useful projection, and our projection in here is that we do see a little further dropping away to 47 on the TWI, so as things are at the minute, roughly equivalent to 45 on the TWI, late this year?
Like the end of the year? Sorry.
By the end of this year, by late this year. That's been helpful to us, in that we're not particularly concerned about inflation at the minute, and it's making exports much more competitive and turning that current account deficit around much faster.
You forecast inflation back towards the middle of your target band. Why can't you cut the official cash rate more?
But we have just cut the official cash rate. You mean more?
50 basis points and closer to zero.
Well, the current program of existing cuts in the cash rate and those that are implied by where we have the 90-day interest rate track deliver the inflation CPI rate right in the middle of the track. It's currently going down a big fall, but that's basically a statistical feature of oil prices coming out. It then goes back into range and broadly then goes out to 2%, middle of the range. And that's, insofar as we're focused on anywhere, that's where we're focused.
Can you talk a bit more about this issue of competitiveness in the international markets? Is the current account deficit stopping you from cutting the official cash rate lower?
No, that's not been a big driver in our OCR decision. Tended to be more a driver when the New Zealand dollar was very high and there was a risk of us pushing it up even further or having an effect of pushing it up further by tightening. It's not the issue at the minute.